If you all were expecting me to stand up here and tell you exactly where interest rates are going, you are going to sorely be disappointed because I have no idea. And sometimes when you look at some of the things coming out of the Fed, I don't know if they know either, to be honest. There's a lot of questions out there right now, and we'll kind of highlight some of that stuff as we go through, looking back at what has happened this year and where we might be headed to into the future. But as Rich said, my name's Briggeman. I'm an associate professor in the Department of Ag Econ here at K-State. I'm also the director of the Arthur Capper Cooperative Center. So a bulk of my time is spent working with farmer cooperatives in particular, helping them work through some of their issues, doing some training programs, really just kind of talking about what's going on in the world of agribusiness, the global economy, what's flowing through and affecting them today. Today, though, we're going to be talking a little bit more about some of the interest rate outlook and kind of where we're at and drawing on my Fed experience. That was a great experience that I had when I was working at the Fed. I learned a great deal about how things within the macro and global economy flow through and affect us in agriculture and in rural America. It's kind of given me a unique perspective on some of this stuff and kind of where we're at. So we'll have some of that come through. And yes, even though I'm on camera, I will give my opinion. That's one of the things I like about being back in academia. I can give opinions, and it's kind of fun that way. So you got the handouts as we go through. I did have to make some adjustments to it, given some of the more recent things that have come out that affect us in this macroeconomic outlook and interest rates. So feel free to follow along as I go in looking at it there. Really, within the Fed, it's always a debate largely between the doves and the hawks, right? The doves tend to focus more on, the dual mandate, the particular one of focusing on the labor market, right? Ensuring we have a fully employed labor force, unemployment's at a reasonable, sustainable, natural level, that we have steady wages and salaries growth, that we have that fully employed workforce. And typically that is associated with easy monetary policy, right? Lower interest rates, making sure we have ample liquidity, the focus on that. But what we also have is on the other side, the hawks, right, who tend to focus on future inflation. Where's inflation at? We need to make sure that the market is under control. That's the other dual mandate of the Fed, right, to ensure that, we have those stable rising prices of goods and services, that stable inflation. And certainly, since the financial crisis, that things have really been a very heated debate, and most of the discussion and most of the decisions have fallen to the doves, right, where we have had a much more loose monetary policy. I think that's one way to say it maybe nicely. We've had ultra-low interest rates for an extended amount of time. We've had ample amount of liquidity shoved into the marketplace. But more and more, we've seen the hawks kind of come out. When I worked at the KC Fed, President Tom Honig was my bank president at that time, and he was one of the more outspoken individuals against that monetary policy. Current Fed President Esther George at the KC Fed has really continued that. And really, where at the heart, it's not so much the future inflation is what they're really truly worried about. It's more, where are investments being made? Where is this money flowing to? And the thing of it is, and Tom would always say this, and I think he was exactly right, and it was a great way to say it, how well does a market function when the price of that good is equal to zero? Interest rates are equal to zero. How do you have pricing signals in order to make wise investment choices? Where do you go? So the concerns of reaching for yield, stretching out maybe more than what we should, taking on riskier investments, become much more appealing. And to be honest, I've sat in plenty, of boardrooms and have had plenty of discussions with agribusinesses and even farmers to a certain extent. For you guys in this audience, why would I want to lock in interest rates? Why would I want to fix them? Variable rates are incredibly low. That spread that has been created between short-term and longer-term rates is tremendous. So why would I want to miss out on that party? Right? Why? So then the question becomes, all right, when's that spread between shorter term and longer term rates going to start to narrow up a little bit, right? Fed created it through the zero-bound interest rate policy, as well as shoving that much liquidity into the marketplace. And if you would have asked me a year ago today, I would have been willing to put money on June 2015, get ready for that spread between shorter-term rates and longer-term rates to start to narrow. Why? Ben Bernanke and all the FOMC before then had spent really years, a couple of years, preparing the market, preparing everybody that June 2015 looks like the appropriate time in which we will start raising rates. Now, they never definitively said it, but you guys know, I mean, good night. The market is very cognizant of what the Fed, FOMC, what they say. So that it was a preparation for the market on June 2015. This is when it's going to happen. And they didn't do it. Right? Left rates at the zero bound. So now you want to ask me what's going on? I don't know. You tell me. Right? It's really about anybody's guess. And if we look at some of the statements that were coming out, you had that, the two opinions that were butting up against each other. Right? We had James Bullard, the president of the St. Louis Fed, talking about how there's a strong case that we can have higher rates. And he's right. Labor markets have improved. Right? We've seen improvements there. Unemployment rate has fallen. Not just the U3 number, but also the U6 number that captures more the discouraged workers that are out there in the labor force. Right? Those numbers had improved. Now, if we look at what Chairman Yellen said, and when she came out with the stance of saying, no, the committee's decision is to leave rates at the zero bound, there was a new thing. I mean, she admitted that, labor markets, nearly balanced. She had, and economic activity had improved. But this whole other dimension was added into there. But monitoring developments abroad. So in other words, the international marketplace, the global marketplace, factored into the decision. And now, I don't know this for sure, but I would love to go back and look and see, has that ever been part of a statement? Because a lot of the journalists out there who follow the Fed, who talk about this is the first time that we've ever seen that come in as a reason to leave rates low. So have we introduced a new role for the Federal Reserve Bank of the United States of America to be the Federal Reserve, the central bank for the world, for the globe? Holy shnikes, that's kind of take you back, right? That's pretty amazing to think, like, can we really be that? But in this statement, it was definitely something that was discussed. Things that are going on in China, the Eurozone issues that they have, problems abroad coming in and factoring into our decision to keep rates low, right? But then to even add more confusion to this whole discussion, this is some of the stuff I had to add, and I've got some backup slides if we have to go to it. This one isn't in your slides. But Chairman Yellen came out in a speech just a week after her initial statement to leave rates at zero, basically making the case for why rates are going to go up later this year. Now hold on. It was a year or years to prep the market to get ready for an interest rates to go up, and you didn't do it. And now all of a sudden in a 40-page paper with graphs and appendices and all these footnotes and academic stuff, and you talked for an hour, you're going to convince us that rates are going to go up at the end of this year? I mean, really? I don't know. I really don't know. Will it happen? Obviously, it potentially could, but certainly I find it funny. And in some ways, I kind of wonder, was this speech written for June, right after the release of saying, we're raising interest rates? Oh, by the way, here's my 40-page paper that backs it up. Right? I don't know. I really don't know what interest rates are going to do coming forward here. You would think that eventually they're going to come up. And here in a little bit, we'll see some of what the FOMC committee produces in their dot plots to try to get some insights into what at least they're thinking. If you go back and look at some of that data, you can kind of pick out some of the things that we can see at least for the forward-looking. But in our current situation where we're at, this is where we're at looking at the effective Fed funds rate, right? The rate in which banks lend to each other overnight is held at that zero bound, so it's being traded between 0 and 25 basis points. And I like to put this chart up just to see some historical perspective. at least as far back as I can pull that data, right, going back to the mid-50s, late 50s, we did have very low rates, not the zero bound, but they were very low. And typically you see, during periods of recessions, these shaded bars, that rates fall, those rates fall, those rates fall. And then period of recovery, you tend to see maybe rates rising as the Fed tries to cool the economy, right? But with this tool, this is a powerful tool, right, the Fed has. It's very clear. It's very obvious what we're trying to do, right? If I raise interest rates, I'm trying to cool an economy that's growing too fast, right? It's a very clear signal to everybody. When I lower it, right, when I lower rates, that's saying, well, we're trying to kickstart the economy. We want to get that borrowing and lending function to ramp up like what you guys do in this room, right? Get the economy kickstarted, shot in the arm, time to go. But with being at the zero bound, that policy choice, it's been pulled away from the Fed, right? So what they've done is they've created quantitative easing, or gone into a quantitative easing position where they're shoving liquidity into the marketplace. So to show this, right, I put up the Fed balance sheet, their asset side, so the value of all the securities that they hold on the balance sheet. And there are two things largely I want you to take away from this graph: the size and its composition, right? So first thing with the size of this graph. If you look back in more normal times, right, pre-financial crisis, Fed usually had anywhere about $850 billion in assets, right, roughly. But when the financial crisis happened, financial markets shut down in September, October 2008. Short-term credit markets or lending facilities, credit facilities were created. A lot of liquidity was shoved into the marketplace to the tune of about $2 trillion. Then that wasn't enough to keep us going, to get us out of the recession, the financial crisis. Need to kickstart recovery. We started quantitative easing. We did another round of quantitative easing, raised it $2.5 trillion. Did another round, raised it up to about $4.5 trillion. Now, I don't know about you all, but I'm kind of a visual learner at times. I honestly didn't have a concept of what a trillion looked like, right? What is a trillion? What is that? So this is something that I get to do because I work at K-State. I can go through fun slides like this. So what does $1 trillion look like, right? So we got a $100 bill. We all kind of know what a $100 bill looks like. Got a sense of size, scale, fits in your pocket really easily. If we got a packet of them, a bundle of them, we can put $10,000, right? Nice, fits in your hand, easy in your pocket. Nobody might not even know you got 10 grand sitting on you. $1 million. Now I'm going to put a person in here for a little bit of scale, kind of give you an idea. Now $1 million, right? You put that in a backpack, a grocery sack. Nobody really even know $1 million. But I mean, it's $1 million. That's a lot of money, right? Now we're getting into some money, right? We got $100 million here. You got to have a forklift to move that thing around, right? It's a pallet. We got ourselves a pallet of money. That's nice. Now we got $1 billion. But still, look, we got, 1, 2 pallets wide and 1, 2, 3, 4, 5 pallets deep, right? But it's $1 billion. It's a lot of money. This is $1 trillion. See the guy over here? Little tiny dude. And look at this. These pallets, they're double stacked and how many deep and however many. That's a warehouse of money. And guess what? There's 4 warehouses sitting on the Fed's balance sheet. Right? Actually 4.5. Right? That's a lot of liquidity. A lot that's out there. Right? That's sitting there. And why I think one of the things that's going to be a significant challenge and something we will talk about with the Fed is how do we unwind that? Right? How does that come out? Right? How do we unwind it in a way that occurs naturally, that we see it return back to a more normal balance sheet? Okay? That's when the composition piece of the balance sheet does become an interesting topic of discussion. This red area, right? We did this. Those are mortgage-backed securities, right? Ben Bernanke back in 2009 noticed that, the recovery was anemic, not really going. We hadn't really had that kickstart. And I believe in a speech he said that the U.S. economic engine was missing a piston, and that piston was the housing market. Right? And really, back in that time, the Fed was the only game in town buying these mortgage-backed securities. Why? What did we used to call mortgage-backs back in 2009? What was the something assets? Toxic assets, right? Ew, right? Now, the Fed was purchasing these, at a haircut, so they weren't putting it on at market value. They were taking a haircut off of it, but they were putting a lot on. The challenge with this, and the challenge for them is the Fed, the central bank, was picking a winner, right? They were choosing the housing market as a winner within this overall recovery. Now, did they do it right? Maybe. We'll wait and see. There'll be many PhD dissertations written on this topic. I have no doubt about it once we get through it. But how do we unwind these, right? That exit strategy, which there is one in place. I mean, there are multiple things. I know Bernanke has come out with, back when he was in charge, and Yellen still going to op-ed pieces talking about various ways in which they can exit it. I mean, one approach is just let it unwind naturally, right? All these securities have terms on them, right? At some point, they'll expire and see it unwind naturally. Now, that could take years and could be slow and would require slow, moderate growth. But you would think at some point, market signals will clear up, uncertainty will clear up, businesses will really start to invest. They've got a ton of cash sitting on their balance sheets. Things will get kick-started and get going, right? So then what happens there when they need, to start to unwind this? How does that happen? Does it happen in a systematic way that it doesn't create additional market disruptions? Right? The last piece in the composition to think about is this orange area. Those are Treasury securities from the U.S. government, right? And if you take any macroeconomics 101 class, when a country's central bank buys its own government's debt, that is called monetizing the debt. And history, year in, year out, has proved that leads to inflation. Right? But if you remember back during this time, that was really kind of the goal. We were potentially going into a deflationary environment. Those signals were there. We need to avoid that at all costs. Buying government securities did that. Right? So, that is monetizing it. Right? Purchasing that. Now, how will that all unwind again? Going forward is going to be something to follow and to think about. Right? Now, of course, central to this whole story with the different quantitative easing approaches looking at inflation. Largely, there are two types of inflation, and I know us in this room in agriculture really see one every day, day in, day out, and that would be that headline inflation, right? So looking at the prices of goods and services, through the personal consumption expenditures price index, and that headline includes commodities, right? Like oil. So if you look here with that headline inflation drop, the black line, and then you can look back in 2009, we're actually dipped into deflationary area, deflation negative rates, right? We can see how that commodities push it down. But from the Fed standpoint, that's not, it's important, obviously, it's recognized, but decisions on interest rates are made off of a more stable inflation measure where we strip out those volatile food and energy prices, right? Look at the core. Look at those core that excludes food and energy. And if you look at that, it's been pretty stable since about 1997, really kind of hovering around that 2%. Of course, those deflationary fears came in when the core even dipped down, and it's been hovering below that target of 2%. So the Fed, that's their 2% target. And that, to me, makes a lot of sense. If we were making interest rate decisions based off of the price of oil movements, my goodness, that would be crazy. That'd be pretty wild, right? Because when the Fed decides to raise interest rates, it affects everything, right? Everything across the U.S. economy. So we got to be aware of that and make sure it's the right time to raise it. That's what the Fed spends a lot of time thinking about, and looking at these future inflation is certainly part of it. One way to look at future inflation is look at market expectations. This is the 5-year break-even inflation rate. So it is the difference between a 5-year Treasury rate and the 5-year TIPS. So Treasury inflation protected security. Looking at the difference between the two, if you look at the difference, that's where the market at least is expecting inflation to be 5 years from today. So there was a lot of fear, right, in the market during the recession, right, where we saw it actually dip down into negative territory. But with, various quantitative easing, low interest rate, monetary pulled it out, right? At least the market felt that we weren't going to have that. But today, this is where some of those fears are coming in, and largely coming from those outside abroad impact, those things that are going on in Europe and China are flowing through and affecting us, which played into that decision of keeping rates at the zero bound in September. Now, market has been known to be wrong, right? That is there. But certainly this kind of gives us a view, at least, of what the market is looking for on that 5-year inflation. So a couple of things. I think at some point, Chairman Yellen did make the case that rates might go up at the end of this year. I think it's still being talked about, still thought about. What happens, right? Where might there be some problems that would pop up, right? What are some of the things that could be challenged? Well, there are a multitude of things that I could talk about, but in the interest of time, I'm going to focus on two, and largely centered around the debt story. So what I have here is corporate debt pulled down and plotted through time. And if we can look at it, it has surged to just under $8 trillion today. And it's a pretty remarkable exponential curve as it begins to rise. Now, of course, we look at this, and you can see that in the financial crisis, a lot of that debt was either paid off or liquidated through bankruptcies, a lot of turmoil there. But since that time, during this period of the recovery, right back on that curve. It's a tremendous amount of money. Right? We saw the trillion before. Holy cow, that's a lot of debt that's out there. But maybe some folks out there aren't nearly as concerned, right? Because debt can be good. I think we all know that debt can be a good thing. It can benefit businesses for sure, without question. The question comes into leverage, right? How leveraged is corporate America? So what I did is I pulled in and I looked at the debt-to-equity ratio for corporations. And if you look at this debt-to-equity ratio, where we set today, it's not excessively high, nowhere near where we were in the early 90s, and not even close to where we got during the financial crisis, right? Looks okay, right, from a historical standpoint. The question I have for us, are we looking at a graph that we should think back to the 1980s farmland value, or 1980s farm debt crisis? Is this 1975, right? Because if you look back over debt-to-equity ratio, debt-to-asset ratio, whatever ratio, leverage ratio you want to choose, we looked okay. Golden age, everything's okay. Earnings are great. Interest rates are low. Exports are going like gangbusters, like we've never seen before. Farmland values are the highest that they've ever been. What's super high right now for corporations that's pushing this number down, that's holding it down? What's very high right now for corporate America? Stocks, right? Stock market. It's tremendously up. Provides a great deal of equity, right? It kind of helps to hold and make this leverage go down. So what happens if the stock market starts to fall? What happens if we begin to see challenges there? I know there are people out there questioning, do the earning potential of corporations that are traded on the stock exchanges, do they warrant those high prices? What happens if we raise interest rates? We get a lot of disruptions. Maybe we start to see that leverage starting to tick back up, right? And could this lead to a lot of chaos going forward? And remember, we got $8 trillion of debt sitting out there. It's a lot, right? Something to keep in mind, at least as I think about it, when we go forward and unwind this thing, what happens is this debt-to-equity ratio going forward. The other piece is to look at government debt, right? We saw quite a bit of it already sets on the Fed balance sheet. And if you look at it from a total public debt as a percent of GDP or gross domestic product, we're at a level that we haven't seen at least as far back as I could get this graph back to here. And I think, there was maybe only one other time in our history where we got up over 100%, and that's where we are at today, right? Now, Fed decisions to raise interest rates, they are separate from the U.S. government, right? They make their decisions independently. But they certainly understand some of the ramifications of it. And if you look back at Bernanke, when he was trying to set the stage and get people thinking about this, his presentations and reports back to the Senate and the Congress, he was saying, be prepared. What happens to you if interest rates go up? That's a pretty big interest expense payment that could go out. And for some of us in the room, and maybe were lending in the 1980s, that was a huge thing for U.S. ag, right? Seeing those interest expense go up. So could we see that really increase and impact the U.S. government? Certainly could be the case, right? If we begin to see that go up. All right, so where do interest rates go from here? Again, this I'm just going to focus in kind of on what the FOMC, the Federal Open Market Committee, provides to us in their reports. In 2012, they introduced a new graph to us, the dot plot graph, and that's what I have up here for you to look at. So 2012, each time they have one of their 4 projections throughout the year, they provide us an update on where they, as individual members, think the effective Fed funds rate, the target rate, is going to go. Okay? So the thing, we go through and explain it. So this was the most recent one out of September, right? In 2015, this is where most of the committee, each dot represents a projection. Now, we don't know who provided that projection, but we know kind of where they're at. 2016, where they expect that target level to be, 2017, then 2018, and then looking at that longer run, looking out beyond 2018. Where do we expect that longer run target rate to be? Okay? Now, before I get into the interesting red box here, one other thing to note, and you're going to see this here in a little bit, there's a pretty steady trend, except for the long run, that you see always coming out with FOMC predictions, is that this slope, expecting that rates to be low in the near term, but then over 1 to 3 years, 3 years out, rising up to a higher level, closer to that long run. So the thing that I would take away from this, at least the FOMC, as they're reading the tea leaves, and as they make their projections, they expect once these rates begin to go up, 2-3 years, we're going to really get them up. Right? That's what I would take. And you'll see this here in a little bit. It's pretty consistent across. But the thing of it was really fascinating in this last one is we actually had negative interest rates as a projection from one FOMC or Fed bank president. Negative rates. Deposits have a negative interest rate. So I'm going to get charged if I put money into your bank. Yep. But the idea is, I don't want you to put it in here. I want you to use it outside. And this is actually something that is being done, right, in the global economy. The European Central Bank, Switzerland, Denmark, Sweden, they have a negative deposit rate. The idea being, try to kickstart the economy big time. Not using quantitative easing, but let's use negative rates. I don't know about you, but when I think about it, I got to really try to wrap my head around that thing. Because if the price of a good is equal to 0, how well does the market function? How does the market function when the price is negative? I don't know. It'll be interesting to see how it plays out with those other countries. But largely people think who cast this vote, and even Yellen came out that we're not really seriously considering this, is no longer a Fed president. He's the Minneapolis Fed president. Kochela, I believe, took a professorship position in academia somewhere. So he's no longer in there. But they don't know who it is, but people largely think it's him. Right? He's been very dovish. Very, very, very dovish. Right? But anyway, that aside, it's certainly something that's out there and was kind of interesting to see. But what I did was I took those FOMC dot plots going all the way back to 2012. And I plotted them on this graph here for you so we can kind of see what are some of the takeaways that we've seen as it has evolved over time. Okay? So to explain the graph, to look at it, down here along this axis we have the release date for FOMC projection, and then I took that average of the midpoint, average of all those rates that were reported, right? So in 2012, if we look at this blue line, that was the Fed, the FOMC's projected rate, for 2012, right? They started the first release in 2012, the second, the third, the fourth. Well, they only can project 2012 in 2012, and by and large, they had it at that lower level, right around that 25 basis points, right? So if we look up here at more like in the 2014, the thing you start to see is that in 2012, they were expecting those rates to be up over 1% in 2014. And then if we look at the end of 2012, they're expecting 2015 rates to be here. In 2013, expecting 2016 rates to get to there. Another thing to take away, the FOMC didn't do a very good job of predicting their own decision. I say a bit tongue-in-cheek because their decision is impacted by new economic information that comes at them, right? Things will evolve, things will change, things will impact that, right? But, again, you see that consistent rise, right? As they look out into the future, right, they're expecting those rates, once they begin to exit, to begin to go up. But the thing of it is, if you look at their longer run expectations, they have really changed. Back in 2012, they were at a more normal, what we would say, pre-financial crisis interest rate level of about 4.25%. But if you look at it through time, they have dropped that longer run rate prediction. So the thing I wonder about was 4.25%, the old normal, and this is where we're at now, under 3.5%. Do we really think interest rates are going to rise very rapidly back to where we might think it's more normal at 4.25%? Fed's telling us no. They've changed their longer run expectations through time. So even if they begin to rise, yeah, they might rise a little more quickly, but they're not expecting it to get back to levels that we might have seen before the financial crisis. So looking ahead, those rates might remain low. So with that ultra low rates, the excessive amount of liquidity in the marketplace, it certainly has had impacts for us on ag. I didn't get into a lot of those, but certainly farmland has had a benefit of that, right? Dropping the cap rate has certainly made it look more like an investment. It's benefited us from commodities, right? From having higher net farm income, acts like, an accelerant to the supply and demand factors that we had in the past, right? Now, of course, that has changed a little bit today, but it's really, benefited us from that standpoint. And the last thing I leave it before I get into questions, and if you have any, is to also just know, that that exit strategy is going to be key. And if you look at those longer term rates, getting back to that 4.5% Fed funds rate, that might be a thing of the past. We might be in a long haul where we actually do get up, but that 3 might be that new cap, might be that new normal that we would be heading into.